Today we are going to learn about unit number 1 of chapter 9, Introduction to Company Accounts. Hey friends, when we are speaking about company accounts, it's very important to understand why do companies have to prepare accounts, what are the rules governing it, what are the laws governing it. Only when we understand all of that, we will be able to understand and appreciate why final accounts are required. Learning objectives. The learning objectives of this unit are to understand the reason for the existence and survival of a company, to learn the nature and types of companies, to explain the salient features of the company, and to understand the purpose of preparing the financial statements of the company. We will now discuss on why are companies formed. The never-ending human desire to grow and grow further has given rise to the expansion of business activities, which in turn has necessitated the need to increase in the scale of operations so as to provide goods, services to the ever increasing needs of the growing population of consumers, large amount of money, modern technology, large human contribution, etc. required for it, which is not possible to arrange under partnership or proprietorship. Also, there was a need to separate the management from ownership. Accordingly, to overcome these difficulties, the concept of a company or corporation came into existence. Let's understand now the meaning of the company. According to Justice Marshall, a corporation is an artificial being, invisible, intangible, and existing only in the contemplation of law. In the same manner, Lord Justice Hannay has defined a company as an artificial person created by law with a perpetual succession and a common seal. A common thread running through various definitions of company is that it is an association of persons created by law, it is a separate body, and it is made for a special purpose. At the same time, definitions have laid down certain characteristics of a corporate organization which make it out as a separate and unique organization which enables the people to contribute their wealth to the capital of the company by subscribing to its shares and appointing elected representatives to carry out the business. The salient features of the company are incorporated association. A company comes into existence through the operation of law. Therefore, incorporation of company under the Companies Act is a must. Without such registration, no company can come into existence. Being created by law, it is regarded as an artificial legal person, separate legal entity. A company has a separate legal entity and is not affected by changes in the membership. Therefore, being a separate business entity, a company can contract, sue, and be sued in its incorporated name and capacity. A company has perpetual existence. Since the company has existence independent of its members, it continues to be in existence despite the death, insolvency, or the change of members. A company has a common seal. A company is not a natural person. Therefore, it cannot sign the documents in the manner as a natural person would do. In order to enable the company to sign its documents, it is provided with a legal tool called common seal. The common seal is affixed on all documents by the person authorized to do so, who in turn puts his signature for and on behalf of the company. A company has limited liability. The liability of every shareholder of a company is limited to the amount he has agreed to pay to the company on the shares allotted to him. If such shares are fully paid up, he is subject to no further liability. Distinction between ownership and management. Since the number of shareholders is very large and may be distributed at different geographical locations, it becomes difficult for them to carry on the operational management of the company on a day-to-day basis. This gives rise to the need of separation of the management and ownership. Not a citizen. A company is not a citizen in the same sense as a natural person is, though it is created by the process of law. It has a legal existence but does not enjoy the citizenship rights and duties as are enjoyed by natural citizens. We will discuss transferability of shares, maintenance of books, periodic audit, and right of access to information in the next slide. Transferability of shares. The capital is contributed by the shareholders through the subscription of shares. Such shares are transferable by its members except in the case of a private limited company, which may have certain restrictions on such transferability. Maintenance of books. A limited company is required by law to keep a prescribed set of account books, and any failure in this regard attracts penalties. Periodic audit. A company has to get its accounts periodically audited through the chartered accountants appointed for the purpose by the shareholders on the recommendation of the board of directors. Right to access information. The right of the shareholders of a company to inspect its books of accounts, with the exception of books open for inspection under the statute, is governed by the Articles of Association. The shareholders have a right to seek information from the directors by participating in the meetings of the company. So guys, have you got what are the salient features of the company? If yes, if no, whatever it is, please repeat it with me. It's incorporated association, it's separate legal entity, its perpetual existence, common seal, limited liability, distinction between ownership and management, not a citizen, transferability of shares, maintenance of books, periodic audit, and right of access to information. Please remember this, quite important for your exams. Back to studying. Now let's look at the different types of companies. There are about 12 different types of companies as stated in the Companies Act. Government company. According to Section 2, subsection 45 of the Companies Act 2013, government company means any company in which not less than 51% of the paid up share capital is held by the central government or by any state government or governments, or partly by the central government and partly by one or more state governments, and includes a company which is a subsidiary company of such a government company. Hey guys, when we are discussing about types of companies, there you would find many references to sections and subsections. Though it is not very critical to remember those sections, but it will always be good for you if you could memorize those sections while studying. The slide that you just saw was on government company. You must have dealt to seen with so many government companies. When you do a call, it's Maharashtra Telephone Nigam Limited, MTNL, yes, that's a government company. The fuels that you fill up, Bharat Petroleum, that's a government company. So companies in which government owns equity shares is called government company. Government could be central government, state government, or both. Now, you would have read in civics in school, right? What is the central government and what is the state government? Do you remember it? I know for sure that you will remember it. Back to studying. Foreign company. According to Section 2, subsection 42 of the Companies Act 2013, foreign company means any company or body corporate incorporated outside India which has a place of business in India, whether by itself or through an agent physically or through electronic mode, and conducts any business activity in India in any other manner. Private company. Section 2, subsection 68 of the Companies Act 2013 defines a private company as a company having a minimum paid up share capital of 1 lakh rupees or such higher paid up share capital as may be prescribed, and which by its articles restricts the right to transfer its shares, except in case of one person company, limits the number of its members to 200, provided that where two or more persons hold one or more shares in a company jointly, they shall, for the purposes of this clause, be treated as a single member, provided further that persons who are in the employment of a company and persons who have been formerly in the employment of the company were members of the company while in that employment and have continued to be the members after the employment ceased shall not be included in the number of members, and prohibits any invitation to the public to subscribe for any securities of the company, and shares of the private limited company are not listed on a stock exchange. Public company. Section 2, subsection 71 of the Companies Act 2013 defines public company as a company which is not a private company, has a minimum paid up share capital of 5 lakh rupees or such higher paid up capital as may be prescribed, provided that a company which is a subsidiary of a company not being a private company shall be deemed to be a public company for the purposes of this act, even when such subsidiary company continues to be a private company in its articles. One person company. Section 2, subsection 62 of the Companies Act 2013 defines one person company as a company which has only one person as a member. Small company. Section 2, subsection 85 of the Companies Act 2013 defines a small company means a company other than a public company, paid up capital of which does not exceed 50 lakh rupees or such higher amount as may be prescribed, which shall not be more than 5 crore rupees, or turnover of which as per its last profit and loss account does not exceed 2 crore rupees or such higher amount as may be prescribed, which shall not be more than 20 crore rupees. Listed company. As per Section 2, subsection 52 of the Companies Act 2013, a listed company means a company which has any of its securities listed on any recognized stock exchange. The company whose shares are not listed on any recognized stock exchange is called the unlisted company. In case of private companies, shares are not listed in any stock exchange. Unlimited company. Section 2, subsection 92 of the Companies Act 2013 defines unlimited company as a company not having any limit on the liability of its members. Company limited by shares. As per Section 2, subsection 22 of the Companies Act 2013, company limited by shares means a company having the liability of its members limited by the memorandum to the amount, if any, unpaid on the shares respectively held by them. Company limited by guarantee. As per Section 2, subsection 21 of the Companies Act 2013, company limited by guarantee means a company having the liability of its members limited by the memorandum to such amount as the members may respectively undertake to contribute to the assets of the company in the event of its being wound up. Holding company. According to Section 2, subsection 46 of the Companies Act 2013, holding company in relation to one or more other companies means a company of which such companies are subsidiary companies. Subsidiary company. Section 2, subsection 87 of the Companies Act 2013 defines subsidiary company as a company in which the holding company controls the composition of the board of directors, or the holding company exercises or controls more than one half of the total share capital, either at its own or together with one or more of its subsidiary companies. A company shall be deemed to be a subsidiary company of the holding company even if there is indirect control through the subsidiary companies. A company shall be deemed to be a subsidiary company of the holding company even if there is indirect control through the subsidiary companies. The control over the composition of the subsidiary company's board of directors means exercise of some power to appoint or remove all or a majority of the directors of the subsidiary company. Companies can be grouped as follows. Nature of companies. This would include company limited by shares, company limited by guarantee, and unlimited company. It can also be grouped by company limited by shares general, which will include private company, public company or listed company, one person company, small company. Or it can be grouped by company limited by shares on basis ownership, government company, foreign company, holding company and subsidiary company. Now we will discuss about maintenance of books of accounts and preparation of financial statements. Maintenance of accounts. As per section 128 of the Companies Act 2013, every company shall prepare and keep at its registered office books of accounts and other relevant books and papers and financial statement for every financial year, which gives a true and fair view of the state of the affairs of the company. The relevant books and papers should be including that of its branch office or offices of any, and explain the transactions effected both at the registered office and its branches. Such books shall be kept on accrual basis and according to the double entry system of accounting. Provided further that the company may keep such books of account or other relevant papers in electronic mode in such manner as may be prescribed. Preparation of financial statements. Under section 129 of the Companies Act 2013, the financial statements shall give a true and fair view of the state of affairs of the company or companies, comply with the notified accounting standards, and shall be in the form of forms as may be provided for different class or class of companies as prescribed in Schedule 3. The Board of Directors of the company shall lay the financial statements at every annual general meeting of the company. Preparation of financial statements. Financial statements as per section 2 subsection 40 of the Companies Act 2030 inter alia include a balance sheet as at the end of the financial year, a profit and loss account, or in the case of a company carrying on any activity not for profit, an income and expenditure account for the financial year, cash flow statement for the financial year, a statement of changes in equity if applicable, and any explanatory note annexed to or forming part of any document referred to in subclause 1 to subclause 4. Provided that the financial statements with respect to one person company, small company and dormant company may not include the cash flow statement. As per section 129 of the Companies Act, it is mandatory to comply with accounting standards notified by the central government from time to time and Schedule 3 of the Companies Act 2013. As per section 129 of the Companies Act 2013, financial statements shall give a true and fair view of the state of affairs of the company or companies and comply with the accounting standards notified under section 133 and shall be in the form of forms as may be provided for different class or classes of companies in Schedule 3 under the Act. Now, let's look at how the balance sheet is made up of and how it looks like. On your screens now is the balance sheet. The balance sheet has primarily two sections, equity and liabilities and assets. In equity and liabilities, it has four basic sections. The first section is of shareholders' funds, which contains share capital, reserves and surplus, and money received against share warrants. The second head is on share application money pending allotment. The third head is on non-current liabilities, which includes long-term borrowings, deferred tax liabilities net, and other long-term liabilities and long-term provisions. In current liabilities, we have short-term borrowings, trade payables, other current liabilities, and short-term provisions. On the asset side, we have non-current assets consisting of fixed assets, which include tangible assets and intangible assets, capital work in progress and intangible assets under development, non-current investments, deferred tax assets net, long-term loans and advances, and other non-current assets. In current assets, we have current investments, inventories, trade receivables, cash and cash equivalents, and short-term loans and advances, and other current assets. The figures as at the end of the current reporting period as well as of the previous reporting period are given. This forms the entire balance sheet as it's in front of you. The statement of profit and loss has about 16 items. The 16 items, or as we call captions, are as follows. It starts with revenue from operations, other income. The summation of two gives you total revenue. Then you have expenses, which is cost of materials consumed, purchases of stock in trade, changes in inventories of finished goods, work in progress and stock in trade, employee benefits expense, finance cost, depreciation and amortization expense, and other expenses. This gives you total expenses. After you reduce the total expenses from total revenue, you get profit before exceptional and extraordinary items and tax. Then you have exceptional items, which gives you profit before extraordinary items and tax. Then you reduce from that is extraordinary items, then it gives you profit before tax. And so forth and so on, you reach up to the net profit. After the net profit in row 15, you also give earnings per share, which is broken up into basic and diluted. Don't worry students, we are going to discuss each and every line item in other units, other modules and future discussions. This is just to show you how does a balance sheet and a profit and loss look. Now it's the time to test your knowledge. Answer the 6 questions, write down the answers and check the answers back to where you started from. There will be a link which will give you answers to the unit-wise questions and then you can check your answers there. Thanks for a patient hearing. Thank you.